Thanks for tuning into BQ Prime. We are covering the World Economic Forum at Davos at a chilly afternoon, I must say, or evening India time. And if Howard Marks agreed with me last week that it's time to move from Tina to Tara, we thought it's best to talk to somebody who's a behemoth as far as the alternative space go. Investcorp is a very popular name, very well-known name across the world. And the co-CEO of Investcorp, Rishi Kapoor, is with us right here in Davos to talk about whether he believes that it is indeed time to move from Tina to Tara. So equities to alternatives, Rishi, you must be glad that it's happening.
Well, let me start off first of all by saying two things. One is it's great to be with you
Thank
back
you.
again, and the second is chilly afternoon is an understatement, my friend. So, but yeah, let's go back to the point you were making. You're spot on, Neeraj. As we think about ourselves and others like us that are very active in the private markets alternative space, we see after a long period of time, the genuine return of what I prefer to call QUARP, right, which is quality at a reasonable price.
Okay.
We are able to see investment opportunities to deploy capital into quality assets
Uh-huh.
where valuations are, reasonable, where the potential for long-term fundamental value growth in a sustainable fashion is genuinely there, and which we can monetize and realize down the road.
So if quality equity assets or in quality assets, if equity is available at a reasonable price, and at the same time, if we indeed, let's say, agree with Howard that there is a sea change in that rates have moved up and therefore non-equity assets, private credit, debt, etc., are also now become a lot more attractive. What do you think is the course over the next 2, 3, 5 years? Is it an equitable distribution between all asset classes because even equity is available at reasonably, or you believe the non-equity assets will be a lot more attractive and lucrative?
So let me start by referencing the private credit asset class
Sure.
first, because you used a very interesting term, and I should remember to reuse it if you don't mind myself. Equitable distribution across asset classes, right? Private credit, for the longest of times over the course of the last decade or so, has been under the overhang of a very low interest rate environment, right?
Yes.
Virtually zero interest rates, base rates. Now base rates are close to 4 or 5%, right?
Mhm.
Which means the private credit asset class, which is indexed to floating rates, suddenly has seen an expansion of total return on investment within private credit by 400 to 500 basis points.
Right.
So clearly, that inequity that existed in that asset class has been removed as a consequence of the new regime that we find ourselves in. Private equity itself tends to be more absolute return focused than spread focused.
Sure.
So it is more than likely that whilst return expectations from investors will stay, constant at around the mid to high teens level, what we'll see is that the bookends of ranges around outcomes against that central expectation are going to narrow because of the availability of good quality assets at a reasonable price that we expect to be the case at least for the next couple of years into 23 and 24. Real estate also, because of the very ultra low loose monetary policy and the low interest rate environment, had benefited greatly because you could finance real estate assets at very low prices. Real estate is going to require a new equilibrium to settle in. What I mean by that is real estate tends to be priced at a premium to the financing rate, and that pricing premium has got to come back, right?
Okay.
Real estate is such a large market globally and in all the key markets that we operate in, that we anticipate that reversion of equilibrium to be sooner rather than later, at which point in time, because it is an inflation indexed asset class just
Mhm.
like infrastructure,
Mhm.
it ought to become extremely appealing to investors worldwide.
Interesting. So actually, real estate would be fairly diverse across markets. Like, so, I mean, I'm just trying to think of it from an Indian perspective. For the longest time, uh, in India, the yield on rentals was pathetic. I mean, owning a real estate and renting it out wasn't as lucrative as renting out. Off late, if I look at Mumbai or some other markets, prices may not have necessarily moved up as much, but rental yields have certainly moved up. So it's very diverse across markets. How do you see um, Indian real estate if you have a strong view there, vis-a-vis, let's say, maybe some of the other markets?
So let me start off with where we developed our core competence in
Sure.
terms of real estate. It was all US centric
Okay.
for till very recently. 5 years
Hmm.
ago, if you had looked at our real estate portfolio, 100% US, right? And there we have been investing for 40 odd years in core plus real estate, which is basically yielding assets, rental only, no new development, no high value add, nothing, no
Right.
repositioning, refurbishment. And that playbook, as you rightly pointed out, depends heavily on what the rental yield is. You know, and US markets have been quite efficient on that front. What we have done over the course of the last 5 years in particular, Neeraj, is we've transported that core capability and experiential base that we developed in the United States into our two new markets, Europe, UK and continental Europe, and India. But we've done it with a very specific focus around two segments of the real estate market in particular. Number one conviction, global, right,
Okay. Yeah. Yeah.
is around logistics, infrastructure, distribution, warehouse centers, right? Not just because of the adoption of e-commerce globally, but also led by the more recent trend of building resilience in supply chains, nearshoring, reshoring, and so on. And that we see across the globe. And that is a very attractive space. And there, the yields are actually quite attractive,
Got it.
right? Number one. Number two, in the US, it has been around multifamily, but the broader theme is around residential, including student housing, right? So student housing is a space we like. We've invested in student housing in the US. We've invested in student housing in the UK. We've invested, in schools and peripheral areas related to education in India.
Right.
So in India, going back to your question, the two themes that we are pursuing, one is a very, kind of secular theme around logistics warehouses, and the second is a softer infrastructure theme around long-term assets, which are inflation linked, i.e., schools.
Yeah, warehousing certainly seems to be the thick of things. A bunch of startups, a bunch of how do I say, not necessarily REITs, but companies which are trying to do that model in an informal way are actually focusing on the warehousing side in India. So that seems to be the order of the day. Now, the other piece, Rishi, is private credit. And I know you spoke about it briefly, but I just wanted to understand. In India, it's still, I mean, for lack of a better word, a nascent market, so to say.
Yes,
Three, four, five
yes,
players
yes,
at
yes.
best, not too many. But people are now starting to pick up that pocket. How do you see the growth of that market in India?
It's still to evolve. I mean, if I think about the general order of play, right? Even if you trace your steps all the way back to how the US market evolved,
Hmm.
and then how the European market evolved, etc. US private equity started first, then it came across to Europe, then private credit came behind private equity, and it's most developed in the US market. Even in Europe today, private credit is not quite as evolved. You know why? Because it's still largely a bank led market. India is an even more bank led market. Emerging markets tend to be bank led
Right.
markets, right? Because the flow of credit and the risk return adjustment that is necessary is not quite as prevalent in the private markets yet. So, exactly in the same sequence, the playbook that we have followed earlier in the United States, subsequently in Europe, and now in the emerging markets, including India, is initially PE, closely followed by real estate, and private credit shall, inevitably become a deeper, more mature asset class. But that is not the case today.
So there are players who in that space, and I don't know what your plans in India about private credit. There are players in India who are offering annual returns of between 15 to 20% pre-tax in private credit. Do you? I mean, and like which is why I said it's a nascent market, but not too many people talk about such high returns and still talk about that pocket as well. So what's missing
So
here?
I'll you asked it, frame the question the right way. What's missing is the following: when you look at that return of 15-16% from the lens of a foreign institutional investor, two things happen, right? One is net of tax, and the second is net of the expected depreciation of the underlying currency,
Currency,
which is 2.5 to 3% per annum on average. You're looking at a net rate of return that is in the high single digits. If that same investor can get the same net return by investing in US markets and European markets, their conundrum, their paradox is they're not getting the perceived risk premium
sure,
of investing in an emerging market.
sure, sure.
And the absence of that risk premium is what deters the flow of capital into that asset class from out foreign investors. For domestic investors, I completely agree with you, right? I would think that it is entirely natural for high net worth individuals, family offices from India to be deploying increasing amounts of capital into the private credit space in India, right? And that we would certainly look to wish to tap into. I mean, that is a secular trend, and I think it's going to manifest itself sooner rather than later.
So where are you in India currently compared to where you were maybe whatever say 6 months, 12 months ago, and in the pecking order for you, 5 years time horizon, what would the pecking order be? Very including equity.
Of course, of course. So, I mean, first of all, I should mention that whilst Investcorp itself has now been in operation for more than 40 years, in
Sure.
fact, last year was our 40th anniversary. Uh,
Congratulations.
thank you for that. You know, the irony is in India, we are not even 4 years old yet, right? So, we started our journey in India really in the early part of 2019. But despite that potentially late start, relatively speaking, compared to our own history, India has been one of the most active markets for us over the course of the last less than 4 years in terms of the number of deals that we have done.
Mhm.
Just in the last 3+ years alone, we've done 15 new investments. That is very significant.
Sure.
And as a consequence of that, today where we are at is, we've raised more than $750 million from our clients for investments into India. We've got AUM of close to a billion already now, but that's just the beginning. This market for us, we feel, is a $5 billion market for us, right, from an AUM perspective. And we want to be, there within the next 5 years, which means not a doubling, not a tripling.
You'll
I'm
add a
talking
billion
about
every
a
year.
yeah, exactly. I'm looking to add, a billion every year over the course of the next 5 years. And I think it is entirely achievable because the size of the market and the size of the opportunity within the market and the maturity level that it has now achieved, I think portends well to get there.
Great. My final question. I know it's cold. My final question, really, and that is, you've been here for about 2.5 days. What is it that you hear about people wanting to invest in India, not just from investing money perspective, but you must be talking to corporates as well, global in nature. What are they talking about when it comes to setting up shop in India? If indeed you're having those conversations, what people are talking to you about that?
So, not only have I been here for actually the last 5 days, in fact, because I had come for another, on the sidelines of
Uh-huh.
Davos, another coalition that is around the real estate industry. But I've been coming to Davos for
Of
more than a
course,
decade,
of
right? And
course.
I'll tell you something because it relates directly to the question that you posed. In my earlier years, when we used to have discussion around investment opportunities in India, there was always some hesitation, particularly on the part of foreign investors, whether it's investment institutions or corporates, as you said,
Hmm.
right? Hesitation out of fear of the unknown, some perhaps bad experiences, direct or indirect, that you read about, etc. Today, when I come here and I have that same conversation with the same counterparties, including us that have now been there for
Yes.
4 years ourselves, I don't hear that hesitation, that fear of the unknown anymore. Not even once have I heard that, oh, India, no, I'm not entirely sure. None of that, right?
Wow.
What you actually hear is something exactly to the contrary. You cannot ignore India as one of the global superpowers. It's a quad polar world, basically, is what people are saying. US, Europe, China, and India, right? B, it's one of the fastest growing large markets and a homogenous market at that, with a growing middle class that is going to be seeking access to consume goods and services, albeit at an affordable price point today because it's not really that luxury oriented yet. It's value conscious, but nevertheless, the quantities and the volumes we are talking about are huge, right? And it is a young demographic that is expected to continue to be young for the next 30 years. So India is very much on the horizon. And I think some of the regulatory advancements that the country has made over the course of the last 5+ years has helped the cause. But more importantly, what has helped the cause is the stability of the economic regime, if you will. So investors are now beginning to see not just the opportunity to invest capital, but the returns on that capital and the return of that capital. And that turns the flywheel. And I think that is really what has changed. And it's not just a sense that I have. I know this because we talk to our investors all the time.
Yeah, and viewers, that's a very, very large, over $45 billion AUM company talking about this. So we take it very, very well. Rishi, thank you so much for
We reach
speaking.
50 billion, by the way. So,
Okay, so excuse me for that, but thank you so much for
no, it's a
talking to us
pleasure.
today, and have a great remainder of the forum.
Thank you. And you too. Take care.
Thank you, and viewers, thanks for tuning in.